My friend Peter Costa joins us right now, former Wall Street market analyst, stock trader, governor with the New York Stock Exchange, and more. Also television analyst on CNBC. Peter, good morning to you. I appreciate you spending a few minutes with us.
Oh, I'm glad to be here, Richard. You know, it's a tough Tuesday, especially since you're wearing your Ole Miss golf hat, and I'm not wearing my University of Tennessee paraphernalia. You know, we move on.
Yeah, that was a tough one. I think Tennessee's a good football team. I really do think. I think they're a good football team.
Well, I think they're better than I originally had thought they were because I didn't think they were going to have a shot against Georgia, only because, number one, Georgia has their number. It doesn't matter where they play. And I think the last 5 or 6 games, they've won by at least 18 points. So their offense looked good. I mean, the defense gave up a lot of yards. And, you know, when they had to make stops, they didn't. But, you know, they'll get it figured out. I think, you know, he's a very good coach. I mean, you know, he's not Lane Kifflin, but sorry. Anytime that comes out of my mouth, I get a little, you know, it didn't end well this year. So.
I understand, but there are a lot of Tennessee fans that would be more than happy to try round 2 and see if it went any better. But
okay.
You know, we would have a lot of fun talking about this for a long time, but I do think there might be some other things that we should jump to, like this Fed meeting that is happening today and tomorrow. You've talked to us a little bit about the Fed. We know that there is a dual role there. Make sure that inflation stays down and people are employed. And they're supposed to do both of those things at the same time, and sometimes those things are a little bit at opposition to each other in terms of rate adjustments and what makes the most sense with policy that they put forth. Look into your crystal ball for us and tell us what's going to happen today and tomorrow, and then we'll get to some of the sideshow stuff as well.
Well, I think that they're almost they back themselves into a corner for some sort of rate cut today. I personally think that it would be in the best interest of everyone, and I'm not just because, you know, I think that President Trump is right about this, but I think that if they did a 50 basis point cut, it would have a huge impact on the economy, and it would have a huge impact on the markets, obviously. But I don't think you're going to see that. I think it's going to be a 25 basis point cut. I don't think there's that much of an argument anymore after looking at, you know, seeing some of the numbers that have come in and some of the numbers that the Fed actually follows. It just seems like they're ready to make that move. And I also think that if nothing really changes and the economy, it's not doing terrible, but it's not doing great. And I think that the jobs numbers are really what pushes the Fed along, because I do think they're getting somewhat of a handle. I mean, inflation's come down a lot. It still needs to come down a little bit more, according to them. Me personally, I think 2.5% to 3%. I think is very livable, because I think that the economy's expanded. There's an expansion in economies during that period. But, you know, they're in a corner now. I think they're going to make a cut. I don't think it's going to be a big one. But I do think one of the things that they will say is that there's a possibility of 2 more cuts by the end of the year, which I think is very impactful.
You think 2 more before the end of the year?
2 more. I think there's going to be 3 cuts this year. I think originally they had said that there might be 3 cuts during the year, and then they weren't doing anything. But I think as the job numbers get weaker and the economy looks like it's softening a little bit, I think they're going to be leaning a little bit towards the more aggressive side, which is very unusual for this Fed board. But I do think we're going to see that. I don't think you're going to see kind of improvement in the job going October, November, and December. I think there's definitely going to be a cut. So,
okay, we'll see what that looks like.
Yeah.
Within the makeup of the Jerome Powell has been made the scapegoat. He has been the target for Donald Trump. Get him out, get him out, get him out. But I think we forget sometimes that there are a dozen governors on this federal board, and they vote on rate cut, no rate cut. How much of what the chairman says influences the way the board votes versus, no, they're going to do what they want regardless of what the chairman recommends or doesn't recommend?
Well, I think he has a lot of sway, but there are certain members in that group of 12. I think there are certain members that will go their own way, regardless of what the chairman says. But for the most part, I believe that they do follow his lead. He is a lightning rod, obviously, but then that's part of the job. You're the head of a institution, especially one that's as important as the Fed. You're going to get there's going to be a lot of commentary regarding the moves, and coming from the president, that's significant, but from the industry as well. I mean, there's been a lot of calls for not so much Jerome Powell being removed, but there's been a lot of calls for him to be more aggressive as far as interest rates are concerned. I think it's a little self-serving because a lot of the people or the economists that are calling for that would benefit, their companies would benefit with lower interest rates. But the reality is, he's going to be the people are going to point a finger at him no matter what. If he cuts rates and he cuts it too aggressively, they're going to point a finger at him. It's not really you're not in a win-win situation as the chairman of the the Federal Open Markets Committee, and there are a couple of members in there that are very strongly want a rate cut. I mean, it's been pretty apparent. They've been out on the road talking about it. So, and that's unusual. You don't really see a lot of division. Usually, these guys all to the.
Yeah, the Fed board seems to, and probably it's probably a poor vision of that board, but it has historically felt kind of apolitical. Like they kind of do their thing, and they really kind of do their thing in quiet unless you're really paying attention, like you're on Wall Street or you're hanging on every jobs report. You're not necessarily paying that much attention to what they do, but like everything else, it feels like it has been politicized. There have been a lot of calls in multiple areas for Donald Trump to stay in his lane, right? You stay in Washington, D.C., you be the president, and you do the thing that presidents are supposed to do. And he's like, no, I'm going to intervene in cities, and we're going to send the National Guard because you're not fixing your crime. And now he's saying, seemingly, you're not doing a good job handling the Fed. We need to get the economy going, and so he's trying to intervene there. How big of a problem is it in your mind to have a president intervening in the Fed? Because there are a lot of people that said this cannot operate under political pressure.
Well, I think it can't. I think it should be completely wholly independent. Every Fed governor, is different. But they do, like I said, they do march to the same tune pretty much during the year because they're all looking at the same data, and they all have the same opinions about that data. So they're kind of in lockstep, but to have political pressure, to me, this is one institution that should not have any political pressure from Washington. I think it should be wholly independent. It has been. I know some other, Federal Reserves and or federal banking institutions in other countries are very much tied up with the administration in charge. I do know that, and it works as well too. But in the United States, I don't think we should have that. I think it was set up originally to be an independent institution. I think it should remain that way. The president can appoint, when governors do something egregious and they are removed,
Sure.
He can appoint new governors, which is fine. It's like the Supreme Court. The Supreme Court is completely independent of the White House, but the majority of the Supreme Court was.
Well, and then we've got a question about this. You're breaking up just for a second. We're going to hang through the break and talk a little bit more with Peter Costa about something that he wrote about yesterday, the AI bubble, and whether or not that is a real thing. Talking about appointees, President Trump tried to do the opposite, which is get Lisa Cook out, a governor that he doesn't agree with on the Fed board. But when we come back, we will first ask Peter this question that we get on the C Spire text line. I hear what you're talking about. How does the Fed rate affect our daily lives? We'll ask Peter that when we come back. It's Mornings with Richard Cross on SuperTalk, Mississippi. Great to be with you on this Tuesday morning, the 16th of September, 2025. Peter Costa is my guest, market analyst, formerly with CNBC, former governor of the New York Stock Exchange. Now he just writes a little bit for a living, props his feet up, hangs out on Long Island, got that cool breeze with a great cup of coffee this morning. Life's good, right, Peter?
It doesn't suck, I could say that.
There you go. There you go. All right, so I threw the question out before the break. How does this affect us? Like Fed rate, we hear about it. It sounds like a bunch of like high finance gobbledygook sometimes. What actual effect does it have on somebody going to the grocery store, buying a house, trying to figure out whether or not they're going to buy a new car?
Well, I mean, directly, it takes a little bit of time for a rate cut to impact you, because there's a lot of things that it does. Number one, it reduces the cost of borrowing operations, which, money spent paying off debt is used for expanding factories, hiring new workers, so on and so forth. So the reality of the situation is when the rates are low, corporations can borrow at a much cheaper rate from banks, and they can use that money to invest in their own businesses. All right. As far as Main Street's concerned, you would think that, credit card rates would become a little bit lower because, the money that the banks are being charged for borrowing that money from the federal government, which they loan to you in a credit card, you would think the interest rates on a credit card would come down, but they really don't, because banks, I think, are a little egregious about how they charge as far as the interest rate they charge. The other thing is mortgage rates. I mean, mortgage rates with lower interest rates at a cheaper rate, they can loan out at it. So that's the direct impact, you would think. All right.
Hey,
we're at a point.
Just a second. You broke up just for a second. Say that about mortgage rates one more time.
Well, mortgage rates should be the first thing and the biggest thing with lower interest rates, because banks borrow money from the federal government to loan you to buy a house. All right. I mean, it's a lot more complicated than that, but the way to look at it directly is they're getting the money from the federal government and they're going to loan it to you with profit. If they borrow the federal government at 3%, they want to make at least 5% profit or 4% profit. There's your interest rates at 7%. As interest rates come down from the federal government or from the Federal Reserve, banks can loan that money at a cheaper rate. This is the way it's supposed to work. I don't think it necessarily works that effectively, but the idea is that if you, if you're a bank and you're borrowing money and you're going to lend it out, you have to make a profit. It costs money to run the business, but you're going to loan it out at a lower rate. That helps mortgage rates. The credit card thing, I think you could put credit card, the interest rates at 0 and still have 18% credit card rate. So I don't think it really impacts credit cards.
I actually want to ask you about that. There was one point early in this administration, maybe even during the campaign season, where Donald Trump talked about trying to put a cap on credit card interest rates, and it caused some people to perk up. I mean, obviously that's not something that banks want. It's an incredible profit center for them. But these are, banks under the guise of credit cards have kind of become like payday lenders in terms of the interest rates that they are charging. In some cases, you mentioned 18%. There are cases where you see 29% or 34% in terms of the interest on the money borrowed on credit cards. Is it a bad idea for the president or the federal or the legislature to look in and go, hey, this needs to stop at 9% or 11% or whatever the number is?
Well, one of the things that, I think that they should do that. And I know some states do have a cap on credit card rates. I do know that. I mean, if you look at your statement, there are, in the small print, there are caveats in there that will say that, like, I'm using Utah as an example, but Utah maybe has a 22% cap on interest rates. That I think is a good idea. And I think the bank use is that delinquencies cost lot of money. In for the last, I'd say the last three administrations, delinquencies there are going up now, haven't been going up for a very long time. So the bank's excuse is that the money is not just the money they borrow from the federal government; it's also the amount of money they lose delinquencies and credit card fraud. I mean, I was in business and we lost money on certain, it's the cost of doing business. And I think that,
Sure.
I do think that banks are egregious as far as the rates that they charge. I think that's something, if the president wanted to address that, I would be 100% behind it. I don't think 9% is a good point because, if you're borrowing money at 2.5%, 9%, it doesn't give them a lot of leverage. But I think that, 13 or 14%, I think could be an effective cap. And I would be 100% behind it. I really would.
Yeah. You wrote yesterday in the Costa's Corner newsletter. You can get that, by the way. Just Google Peter Costa newsletter, and you will see a link to his Substack. You can pop your email address in, and you can get that into your inbox a couple of times a week. Sometimes it's really good. Sometimes you just delete it and you move on because it's not an interesting topic to you. But Peter admits in yesterday's newsletter that he does the exact same thing with newsletters that he gets. So if the topic interests you, check it out. This one yesterday certainly interests me. The idea of an AI bubble. There is untold amounts of money that is being pumped in to the AI space right now. And there's growth all over the place. Sometimes it's scary growth. You talked a little bit about some similarities to the dot-com bubble. Is this a bubble that is going to burst at some point into the future, or is this good investment?
No, I think that we are getting, or we're probably already in that bubble. I mean, looking at a company like NVIDIA, they have a great business model. They pretty much dominate the market in their particular space. But is the company worth $4.3 trillion? I don't know. I don't think so. And Broadcom is another one that's, $1.5 trillion. It's a great company and they have great products and they are profitable. But if you look at the PE yields on these companies, they are getting to the point of being overpriced. You're looking at a company that has a PE of 93. To me, that's just telling you that stock is probably 6 months or a year ahead of itself. So, you don't want to be investing in something like that because when somebody pulls that Jenga tower down of AI, there's going to be a lot of destruction, and it's not going to be all private equity, which I think I mentioned in my article yesterday that Henry Blodgett, who I like very much, wrote an article about that. That's what prompted me to write my article. He had mentioned in that this won't be as impactful on the individual investor, and I disagree because I think that when private equity firms, which are the bulk of the investors in these companies, when they suffer major losses, they have to make up those losses because they have investors that are looking to redeem shares in those investments. And if they don't have the money, they have to sell other products. And a lot of those other products are stocks. So to me, first thing is going to get hurt, but then as an investor gets crushed as well. So I do think we're probably getting very, very close to that bubble bursting. Usually it takes an event that will start that flood of money coming out. I don't know when that's going to be. I can't, there's no way of timing it, but I think that we are in everything I think is priced. I think most of these companies are overpriced. I think the good thing though, Richard, I mean, after you have one of these destructive periods, the companies that come out of it usually do really, really well. If you look at what happened in the dot-com bubble, Amazon got crushed. I think the stock traded down to like $3, and it's been a very good investment from 2000. Microsoft, I think is going to, but I think Microsoft has got such a great business model that, I mean, their portion of their business for dedicated to AI is getting bigger and bigger. but they have a great business. So I think they'll come out of it on, not unscathed, but, they'll be okay. There are some companies that won't exist. And that's the thing that scares you. That's what happened with the dot-com bubble. A company like pet.com, everyone, billions of dollars went into this company with great idea, and they just couldn't produce profits. And when the dot-com bubble happened and broke, that company disappeared. And a lot of companies disappeared after that period. But, the internet is still, it still exists. And I think that AI will exist. I'm not 100% sold that it's the greatest thing. It's going to be that, it's going to be similar to the internet. I really don't think so. I think that it's going to be very helpful. I think there's going to be a lot of advances in it. And it's just going to be another tool out there that we can use at some point. So,
Peter, always appreciate your time. Great visit. A lot to digest with those insights. We'll talk soon, my friend.
Thank you, Richard.
Peter Costa was a market analyst with CNBC, former governor with the New York Stock Exchange. We'll take a time out. We're back with you after this. It's Mornings with Richard Cross on SuperTalk, Mississippi.